Good morning from London. I'm Anna Edwards alongside Guy Johnson and Kriti Gupta. We're an hour away from the opening trade. Here's what you need to know. Going on strike, dock workers walk out of every major port on the US East and Gulf coasts for the first time since 1977. Slow and steady, Fed Chair Jerome Powell says he's not in a hurry to lower rates while reiterating that the US economy remains on a solid footing. And Israel says it has begun targeted ground raids in villages close to the border in southern Lebanon, defying international calls for restraint.
In the meantime, a quick check on these markets here. Green on the screen when you look at the futures picture. Your Stoxx 50 futures higher by 0.2%. Some outperformance in the FTSE 100, perhaps paring back some of the losses we saw in yesterday's session. In the meantime, the bond market keeping a crucial eye on that Fed speak. 378 on the 10-year, 111 on Eurodollar. The countdown to the opening trade starts right now.
Tuesday, the 1st of October. Welcome to the show and welcome back to the 1970s. We've got port workers on strike. You've got an escalating conflict in the Middle East. The Fed thinks it's got inflation under control. And Aviel, our producer, tells us that Suede is back. It certainly feels like we are seeing a repeat, Anna, of the 1970s.
Well, I wonder if we've been through the 70s and this is just some sort of long tail of it. You know, as in the strike activity. Yep. Does this reflect more strike activity to come, or should we see this as a reflection of the inflation impact that we have already seen and is now dwindling? But I don't have the answers. Economists perhaps will have very different views on that. In terms of what the impact is here and now of this strike activity, JP Morgan saying that their transport analysts estimating the shutdown of these ports could have an economic impact of $3.8 to $4.5 billion a day. Of course, some of that is then recovered later on if things get moving again.
I think it's a crucial point. I can't speak to what it's like in the 70s, admittedly, but what I can say is this is a continuation of a labor movement you've seen in a while, and this is crucial because it's coming out of an election year as well, and I think this is really important. We are 37 days out from the U.S. election, and this matters in that a lot of the issues that these port workers have are very similar to what we saw just last year with the rail strikes, with the Hollywood strikes, even in Silicon Valley, some of the conversations there in the labor space.
Plenty of that here in Europe.
Absolutely.
Boeing's on strike.
Boeing's on strike, absolutely. But at the end of the day, Joe Biden has previous iterations, in a way to stem that inflation read-through, has intervened, has stopped these strikes. He's not going to do that this time around.
Absolutely. Too close to an election. It's interesting to see what his motivation is to do that. There was some suggestion yesterday that maybe the White House was on the line, making calls, trying to get this done. But it does seem, as you say, that he has backed off from that. But the impact could be substantial. And even if they finish the strike after a week, the legacy of it could last a month. The effect of it, the backlog, could last for quite some time.
Yes, absolutely. And there's some European impact to think about here, in the sense that European carriers, 4 out of 5 of the biggest container shippers, I think, are European, and so they might be the ones with pricing power here. But in the very near term, there could be disruption as well for them, of course. 35 ships coming in or arriving in port over the next week. They're expected to go to Anchorage. So, this is the kind of logistical headache that European shippers are going to be dealing with.
And I think it was a piece of fun fact, basically, that I read, that every week that this is delayed, it takes about a month to clear on the back end. So 12 weeks, 3 months, it'll take about a year to clear out.
Christmas is coming.
Christmas is coming. It's just off back to school. Yeah.
All of those things need to be factored into the thinking. Let's talk about what this means for central banks. The Fed is definitely already paying attention. Austin Goolsbee has indicated that up in Chicago. He's paying attention to what is happening here. We did see Powell speaking yesterday. We saw Lagarde speaking yesterday. It feels like a bit of role reversal. Lagarde sounding nervous, Powell sounding very calm. Powell's pointing us back towards 25 and 25. That certainly seems to be an indication. Lagarde's pointing us to inflation is well behaved. But I do wonder whether Lagarde's really pointing us to a growth narrative that is becoming more and more difficult for the ECB to deal with right now, and more urgent action is now required. You do wonder whether actually the ECB should have gone 50 a few days back and the Fed should have gone 25.
What does that urgent action even look like? I mean, yes, we've been talking about this weakness in Europe for a very long time. All of these structural challenges that they're facing, not to mention stagnant wage growth as well. And to your point, Anna, the labor union and labor talks that we're seeing across the continent. And yet, it doesn't feel like there's much that the ECB can do. Even if they do go, say, 25 in October or set themselves up for that, how much of a difference will it actually make? Will it stem the pain you're seeing seeing on the continent.
Yeah, it does seem as if they're coming at it from different places, even if they might result in similar action from monetary policy authorities.
Yep.
One cutting because they could, and another cutting because they have to, has been the way that some guests have characterised it.
But I've yet to speak to anybody that can put their finger on exactly why power went for 50. Like, it's really interesting. I've asked this question to a lot of people, and everybody's a bit woolly in terms of their answer. Nobody can quite fully figure out exactly why he went by 50. Maybe just that it's just an optionality trade. The cost of it is actually relatively low, so just do it. That seems to be the most convincing argument at the moment. But I've yet to find anybody that can really convincingly say there was a need to go 50.
Does anyone have the guts to say that he was pressured by the markets? Because that's kind of what it feels like,
But he pressured the markets.
Yeah, he set
with
that
those
up,
articles with in the Wall Street Journal and elsewhere.
He did, but you also had a market that was front-running even that. Remember, we were talking about 6, 7 rate cuts at one point. So to kind of speed that up, I think, is pretty significant. And he still has to deal with not only the election impact, the potential of tariffs coming down the road, and now what these kind of port strikes are going to show up in the inflationary front as well, not to mention any read-through that you're going to see from oil prices.
Back to the 1970s in terms of that inflationary shock.
I can't speak to that.
It came in waves. You missed out. So actually the 80s and the 90s I'm much more of a big fan of. But yeah, the 70s were OK.
Let's turn our attention to the serious business of what's happening in the Middle East, shall we? We have seen Israel carrying out targeted ground raids. Villages close to the border, we understand, in southern Lebanon. The aim, the Israelis say, is to dismantle the attack infrastructure that we have here, Kriti, Hezbollah's attack infrastructure.
They absolutely have. Let's go straight to our, of course, Horizons Middle East and Africa anchor, Joumana Bercetche, who's been covering the story for us. Joumana, walk us through what we know, what the latest is.
Yeah. Well, Kriti, for weeks now there had been speculation that a ground incursion was imminent, and indeed that has occurred now. In the early hours of the morning, IDF put out a tweet saying that they have started striking targets located in villages close to the border that pose an immediate threat to Israeli communities in northern Israel. They are calling it targeted ground raids. And this was also followed up by reports of shelling in some of those towns close to the border, or the so-called blue line, as it's known, between Israel and Lebanon. And then overnight, also local media reporting several explosions, ongoing airstrikes at one of the largest refugee camps on a coastal town called Saida, close to the south of Lebanon, and then further airstrikes on Beirut suburbs in Dhabi as well. That is the part of Beirut that the where the airstrike that took out Hassan Nasrallah occurred. So significant escalation overnight. Now, what we don't know is exactly how many Israeli military troops have been deployed at this time, and also how long they anticipate this ground incursion to go on for. There have been numerous similar types of incursions that have occurred in history, going all the way back to 1982, and not all of them have led to the full withdrawal of Israeli forces. So that is a big question, of course, that people are asking. The second thing is how Hezbollah are responding. And there are reports coming out of Israel this morning that 2 missiles were intercepted that were fired from Lebanon into northern Galilee. They were intercepted, but it does show you that Hezbollah at least are trying to put up a self-defense here, but they have not issued an official statement. The last comment we heard from Hezbollah was from the Deputy Secretary General yesterday, Naim Qassem. He said that the group's forces were prepared to fight on the ground, and we are ready if the Israelis decide to enter by land. This is language that he used yesterday, but of course, Hezbollah are operating in a severely diminished capacity after the taking out of many of their senior commanders, including the Secretary General Hassan Nasrallah last week, and the fact that many of their operatives are critically injured after those telecommunication device explosions the week before. And so, yes, there have been a lot of efforts from the international community to reach a diplomatic solution. There have been calls for a ceasefire, but at this point, they are going unheeded. And actually, what we're hearing overnight is that the Pentagon will be deploying a few thousand more troops to the Middle East in case of a further escalation. And the real risk here is, once again, the risk of a full-blown regional conflict.
Certainly something we're going to be keeping an eye out for. Horizons Middle East and Africa anchor Joumana Bercetche bringing us that update. Again, it's the read-through that we're keeping an eye on. She talked about the escalation, the potential of a regional war. We've been talking about this now for a year, that risk, and what the kind of pricing in of Iran's response may actually look like. Originally, about a year ago, it used to show up very clearly through oil prices, through risk sentiment. You can't see that to that same extent yet, but I'm curious if that is kind of more of a wait-and-see approach.
The US is putting forces into the region. in order, it appears, to deter the Iranian response. So is that going to work? Is that going to be effective? Because that is what everybody is now waiting to see, how that actually materialises, in what shape or form. Does it materialise in the Eastern Mediterranean, or does it materialise elsewhere? I think is another question that people are beginning to ask themselves.
We're seeing European governments wrestling with what to do with their citizens in Lebanon as well. So the British have arranged flights to try and evacuate people, but there are thousands of, just as an example, of Britons in Lebanon. And I know troops are in attendance in Cyprus to try and deal with that kind of evacuation should it prove necessary. We've got a T-Live blog running on this subject, and they're talking there about, asking questions about the long-term strategy of Israel here. And it might be successful in taking out the Hezbollah infrastructure, but that might leave a vacuum near to the border. And who fills that vacuum, after Israel, assuming they retreat at some point? Depends what
position Hezbollah is in at that point, how degraded it ultimately is. All of this folds into the conversations we're going to be having throughout the programme. We're going to discuss the markets. Guillermo, Felicio, PGIM, fixed income global investment strategist, joining us shortly. Also, Lignos, RBC's global FX strategy head, is going to be joining us later on in the show. eBay is removing selling fees for private sellers in the UK. We've seen it in Germany. What kind of effect is that going to have here? Businesses like Vinted have been pushing very hard. Anyway, the general manager here in the UK, Kirsty, Keoghan, is going to be joining us a little bit later on. Plus, the main event over the next couple of hours, Larry Fink, BlackRock CEO and founder, joining Bloomberg for an exclusive interview. He will be joining us from the Berlin Global Dialogue in conversation with Francine Lacroix. So that's coming up. That's certainly something to look ahead to. So in around an hour's time, just under an hour's time, we're going to be hearing from Larry Fink with Francine over in Berlin. Here's what else we're watching for today in terms of data points coming through to us. 10 a.m. UK time, Euro area CPI inflation. We'll get that sort of up sum of all of the inflation signals we've been receiving of late. Other data, of course, around the Eurozone has been weak. 2 p.m. London time, Barnier makes his policy speech. We get some data out of the United States in the form of ISM manufacturing. Nike earnings, that'll be important. This time tomorrow, perhaps we'll be talking about Adidas and how it's doing. And then, of course, we have the VP debate stateside. So the two vice president candidates go up against each other. That's 2 a.m. London time. So I don't know if that's today or tomorrow, but anyway, that's happening overnight. For me, tomorrow.
That's all we need to know. But let's talk about something closer to home, and that is France, Kriti, because I know that this has been something you've been watching very carefully. For the first time, Prime Minister Barnier is going to be addressing Parliament in this role. He's got to put out there a credible budget plan, because we've seen a holding pattern, really, for spreads in Europe, haven't we? Waiting for information around France and what they're going to do.
It's an interesting one, because not only is he keeping out the budget talks, he's going to be saying where in the budget you're going to see pressure, but it's also a political story as much as it is an economic one, and that he has to basically make the case that he can survive a no-confidence vote. And this is also going to be the first element of that, not to mention his take on issues like migration, for example.
I think migration is going to be front and centre. Clearly, obviously, what has happened post the election in France is significant, but it's also being echoed elsewhere in Europe. The right wing is doing better and better, it seems, yet to really get into government, but having an impact nevertheless in terms of the policy formulation. So that's going to be a story. What happens with the pension story? What happens with the pension story in France is going to be really significant. What happens with taxes? Are businesses going to be taxed a little bit more? Is it easier for him to tax business than cut spending? So many difficult things that he's got to deal with right now. Who's got his back?
Yeah, who's really in charge in this sense? Because you were talking about the left wing and what they want to see. They've already said that they want to bring him down. But this leaves the way clear then for Le Pen to be sort of kingmaker, or the opposite of kingmaker, and to try and bring him down if that's what the National Rally decides that they want to do.
He doesn't have to call a confidence vote after this, but he does have to get a budget in place, I think, by next week.
Yeah, that's the deadline. Although I think it has been pushed out slightly just to deal with some of the EU deadlines as well. We should mention Bloomberg Economics has done some of the math on it, and Le Pen's pension plan, as Anna was talking about, could cost as much as 15% of GDP. So that's how dire the situation is.
And it has a long-term effect, a long-term impact on in terms of the growth trajectory that France will find itself with. What else do you need to know this morning? Let's update you. Hurricane Helene has now killed more than 100 people in the United States. Across 6 U.S. southern states, most of the victims died in flooding hundreds of kilometres away from where the storm made its initial landfall in Florida. President Biden says he plans to visit North Carolina by the end of the week. Goldman Sachs executed more than £1 billion of trades in Thames Waters bonds in September. In a note to clients seen by Bloomberg, hedge funds and distressed funds were continuing to bid for the debt of the UK's largest water provider, even as it remains in talks with creditors and struggles to raise equity. And staying in the UK, business confidence has dropped to its lowest level since the Liz Truss fallout. The Institute of Directors, the IOD's latest survey, recorded business optimism fell to negative 38%. That comes amid fears of looming tax hikes and workplace regulations expected to be brought in by the UK's new Labour government. Not so new. We've been in power for a while. The Labour Party's been in power for a while, not we. They have been in power for quite some time.
Yes, we have seen them in
We have
power.
seen. That's
where
how I
you were
started
coming
the
from.
sentence.
There we go. Just to complete that. Right, coming up on the programme, we'll continue to monitor all of these stories. US dock workers walking out. They are walking, as you can see in these live pictures coming to us from Philadelphia. We take a look at how a major strike at US ports could affect the global economy. Plus, Michel Barnier's political tightrope. We talked about that a little bit. What to expect out of the French Prime Minister's speech to Parliament later today. Up next, why Christine Lagarde says the ECB is optimistic it will get inflation under control. What does that mean for bond markets? If you have any questions, if you want to get involved in our conversations, please do get in touch. You can use IB plus BBTV Go. That is the function to put into the Bloomberg terminal. This is Bloomberg.
Inflation might temporarily increase in the fourth quarter of this year as previous sharp falls in energy prices drop out of the annual rates. But the latest developments strengthen our confidence that inflation will return to target in a timely manner. We will take that into account in our next monetary policy meeting in October.
That felt like a pretty clear signal, didn't it? ECB President Christine Lagarde saying she's optimistic that the ECB will get inflation under control. Her strongest indication yet that October is a live meeting and a rate cut looks like it's coming. Guillermo, Felicio, global investment strategist at PGIM Fixed Income, joins us now around the table. That was a done deal. That was Christine Lagarde telling us October we're on, the data are there, inflation is moving in the right direction. Yeah, you're going to get a little blip, but we got this one.
It feels that way. Clearly, inflation is going in the right way. It's actually below 2% in Spain, in France, and if you look at the economy, it's clearly rolling over. So leading indicators like PMIs are weakening, and she sounded like she's paving the way for cuts in October.
How far does the ECB go? Because it's really interesting. You compare and contrast where the Fed is and where the ECB is right now. The ECB is starting from a much lower level because we came out of negative rates. And therefore, it doesn't have maybe the same room to be able to cut. What do we think the strategy is going to be now? Is it to front load, to go early, to kind of push quite quickly and then slow down, or just get to target fast and stay there? I'm just wondering what you think the tactics are at this point.
Yeah, so remember that they started earlier, right? So they have already cut a couple of times, so they have plenty of room to cut further. They have been patient because of services inflation being sticky. And also, if you look at the employment picture, basically the employment rate is still quite low. So they have been a little bit more cautious. But I would say they go in 25 steps, at least...
every meeting?
At least, yeah, every meeting, potentially into, definitely this year and potentially into next year.
Guillermo,
so at least halfway into next year.
Right. Let me just bring in some other commentary we've had on what it is that the Fed is watching right now and pivot the conversation more towards the Fed. We heard from Mike Wilson at Morgan Stanley, and he was giving us this commentary around how important the labour market is right now. Let's just have a listen.
The labour market's everything now. And by the way, it's everything for the Fed.
Yeah.
So, this is the $64 trillion question. Did the Fed cut 50 because they are actually worried about the labor trends, which I think they should be paying attention to that? Or are they doing it because, look, inflation's come down and they're too tight to begin with, and so that they're able to, is the Fed cutting because they can or because they need to?
Guillermo, your thoughts on that? What is it exactly that's making the Fed cut? And Guy was raising this earlier. Why exactly did they go 50? And you're looking for some chinks in the labour market story. That seems to be what everyone is focused on.
Mm-hmm. So remember that the Fed has a dual mandate, right? So it's not just about inflation, it's also about employment. Inflation is pretty much where it should be. If you look at core inflation, ex-housing, for example, it's already at 2%, and the housing component is highly predictable and it's going in the right direction. Employment, is weakening. So if you look at, the unemployment rate, for example, clearly, it's rising. So it makes sense for them to try to achieve to this economy to neutral in terms of their policy stance. So it makes sense to start with a 50 to be in the front foot and then adjust policy accordingly. If you go 50, you're still in restrictive. So the range for the Fed to be neutral is between 2.5–4% for Fed funds, and we're not there yet.
At what point does the bond market stop trading on the monetary policy and start trading on, one, the fiscal policy, which I understand in election years is tricky, but also trading on the budget? And I think that's a question for both sides of the Atlantic. It's the first thing that comes up before the new president is even inaugurated in the States. It's certainly coming up in Europe. When do the bond markets start paying attention?
Look, the market really struggles to multitask. And now, basically, the cyclical issues are front and center. Yeah. So it's all about, basically how far the cutting cycle can go and how weak the economy is. Of course, we know that there are structural issues that are, underlying that cyclical weakness, and those are linked to, the fiscal issues, the election, etc. Those are there, but the market is not focusing on them at the moment.
So the deficit doesn't matter, even on the long end?
It does. It doesn't matter now. It will matter later on. But it's definitely there in the background.
What kind of market moves would that look like, though, when you do start to price something like that in?
Yeah, so you have to start thinking about the term premium. So essentially, when you have this sort of uncertainty about, fiscal policy, about fiscal sustainability, about inflation expectations, you really have to start thinking about how the term premium adjusts. And it has been low for a long time. And that usually affects, of course, the longer end of the curve.
If Michel Barnier struggles to get a grip on the French economy, what do you think French spreads look like over Germany?
That's a great example, right? So in France, of course, this is, a much kind of more important issue at the moment. If we don't get, a decent budget with, some commitment to, to adjustment, then of course those spreads can continue to widen. The interesting thing about France is that if you look at the level of yields, it hasn't really increased significantly. The spreads have, but the level hasn't. So, of course, if we have bad news, that has more room to go up.
OK. Guillermo, thank you very much for joining us. Guillermo Felicio, Global Investment Strategist at PGIM Fixed Income. We thank you for joining us. A bit of corporate news, quickly before we go to break. Abu Dhabi national oil company, Adnoc, as it's better known, has reached a deal, we understand, this is according to people familiar with the story, reached a deal to buy the chemical producer Covestro for about 11.7 billion euros. This would be the biggest Middle Eastern acquisition of a European firm if it goes through expectations. It gets announced today.
And we have a problem with UniCredit taking over Commerzbank.
Lots going on there. We should mention that off of those headlines, looks like Covestro is already gaining about 4.4% on TradeGate as well, so already seeing a little bit of a market move. We're going to dive into more of the market moves, this time in the bond and FX market as well. Coming up on the program, Lignos, Global Head of FX Strategy over at RBC Capital Markets, will join the program. She's going to tell us why investors may be steering clear of the dollar. Do we pay attention to the Fed? Do we pay attention to the deficit? Or is it really, at the end of the day, a positioning story ahead of the election? Lignos is going to shed some light. It's a conversation you do not want to miss. Stick with us. This is Bloomberg.
Looking forward, if the economy evolves broadly as expected, policy will move over time toward a more neutral stance. But we are not on any preset course. The risks are two-sided, and we will continue to make our decisions meeting by meeting.
Fed Chair Jerome Powell, they're speaking at the National Association for Business Economics conference yesterday, saying a lot of what it feels like maybe we already know. This idea that the economy is stagnating in the States, but we're still waiting to see how the Fed is going to react or whether or not they were late to the game with that 50, perhaps early. There's plenty of discussion around it. Lignos, of course, just one mind, Global Head of FX Strategy over at RBC Capital Markets, joins us around the table. I'm tempted to ask you about dollar positioning, but before I do, it feels like the question of the morning, at least between us three, is why did Chair Powell go 50? I'm curious about your perspective on that from an FX standpoint.
And for me, it's really simple. It's the path of least regret. You know, he went 50 knowing that between the last meeting and the next meeting, we get 2 payrolls reports, 1 inflation report. And if you do get 2-week payrolls, it gives them the opportunity to go another 50. And if you don't, they go 25.
It feels very binary like that, if you consider working at the Fed. Talk to us then about the positioning story here as well, because it feels like the dollar is now pulling away perhaps from some of those cut expectations, at least priced into the bond market. I'm curious why that positioning story exists. Do we start to see some sort of reversal around that weakness going into the election, around the election? What do the next 60 days look like for the dollar?
I mean, I think if you look at the forward curve, it's not really the modal forecast, but people have to price in some probability that things do turn out to be worse than expected, the Fed goes faster, and then some weighted probability that, in the base case, they go another 25 at the next 2 meetings, in line with the Fed's own forecast. From the dollar perspective, though, that's not so straightforward to trade, and I think that's part of the reason why people have been trying to steer clear of either going long or short dollars and looking for those cross trades.
Yeah, let's pick up on that theme, because you were quoted in a story yesterday talking about this very subject, Elsa. Where do you see the best opportunities for cross trade then at this point, trying to cut the dollar out of some of your positioning?
Absolutely. So I was here last week talking about short Swiss yen, a trade I still really like. We had a little bit of volatility on Friday around the LDP leadership contest, but fundamentally, to me, it makes a lot of sense. It's an equity-neutral trade, a good RV trade, and in the event of US recession, I do think the yen has a lot more to gain than the Swiss franc. But even in a case where we're just kind of back into carry trades, the yen and the Swiss franc should trade fairly evenly. Outside of that, a lot of people have been looking at short euro sterling. It's kind of stalled just above 83. I can understand why people want to have it on. The data coming out of Europe suggests room for further cuts from the ECB. The data coming out of the UK has actually held up pretty well. The risk there is, as always, positioning. A lot of people like that trade. A lot of people have it on already.
So it could be a little crowded. Thinking about the election and how you factor that in. So if you're not able to put the dollar aside and you have to take a view, or if you've got a longer-term horizon, what are you factoring in as the impact of a Trump versus a Harris presidency? What do either of those two do to your dollar expectations?
So it's interesting. We're having a lot of debate about that internally at the moment, but also externally. I speak to clients who are convinced that if Trump wins, it's a strong dollar trade because of the tariffs. Others say if Trump loses, it's a weak dollar trade because he's so intent on getting the dollar down, he'll find a way to do it. From my perspective, I'm more in the former than the latter camp. Yes, he would like a weaker dollar. Perhaps some of his advisors would really like a weaker dollar. But a lot of the policies he espouses would actually indirectly lead to a stronger dollar.
Who's more dovish right now, Powell or Lagarde?
It's a good question. I think they'd both say we're data dependent. And the reality is, at the moment, the data are pushing the ECB a little closer to a cut than the Fed. But, of course, we've got payrolls this Friday, so a little early to tell for this week. Ask me again.
So how important is payrolls this week? If you see, and which number should we be looking at? Unemployment looks like to be certainly a key area, given what Powell is saying on the labour market front. If unemployment goes down or up, is that the determinant of whether or not we get 50 or 25? I appreciate that we've got more data still to come, but if we get the unemployment rate beginning to fall again, does that confirm the idea that we're going to get 25 from Powell? And does that feel like a dovish or hawkish kind of 25 to the market?
Yeah, I think the Fed would say they're looking at the totality of the data, but there's good reason for that at the moment. You've had this surge in immigration, appears to be waning a little bit now, but the labour force itself has been expanding. So the fact that unemployment has been going up isn't necessarily the surefire sign of weakness that it might have been in the past. I do think the Fed are focused on the replacement rate. What level of payrolls do you need to keep people kind of to mop up the new entrants into the labour market? I think anything sub 100, the market will jump to the conclusion on headline payrolls that we're headed towards a 50-beat cut, and anything closer to 200, and it will all get priced out. It's that kind of area in the middle where I think people will have to exercise judgment and also listen to post-NFP payroll Fed speeches. Yeah, absolutely.
So that's the short-term trade around payrolls as well. Guy and I were having this discussion yesterday around what the long-term rate into payrolls looks like, specifically around immigration policy. I can understand that's probably not your arena, but I'm curious if that's something that you position for in the long term, in your 12-month kind of currency view. Is that something you even take into account, or is that still too far off?
And there are so many factors that come into it over a 12-month horizon, and the two potential presidential candidates have very different policies when it comes to not just immigration, but also tariffs. Fiscal policy, actually, surprisingly, isn't perhaps that different. The composition is very different, but the wish to kind of expand fiscally is not that different. So I think it comes back to what is inflationary. And the inflationary policies, if you believe in the independence of the Fed, and people may question that under a Trump presidency, but I think fundamentally the Fed is very proud of its independence and will fight hard to maintain that, then inflationary policies do lead to higher rates and therefore a stronger dollar.
Elsa, can I ask you about China? Because we've seen such a lot of euphoria around some Chinese assets. Your thoughts on this? What's in it for FX markets? Is this all going to be mostly stocks, and is it all going to be a sort of short-term sugar rush, or is it going to be more material, more sustained, something in it for the underlying economy?
Yeah, a huge amount of euphoria. I mean, it's hard to put it in context, right? 20% in the space of a week. Somebody pointed out it'd be like the S&P going from 5,000 to 6,000 in a week. But I do think, from a longer-term perspective, one thing that's critical is the fact that for the first time, it feels like direct support for consumers is on the table. And yes, so far, what's been mentioned is small, but once you cross that line, there is the prospect for more stimulus of that form to come.
As you look around the world, and you think about kind of what is happening, which is the greater risk? Is it that we continue with this sort of central bank story of rates coming down, that the inflation story is under pressure? That feels like it's fairly well understood at the moment. What does the other end of the tail risk look like, and how substantial is it? I'm thinking about what's happening in the Middle East right now. I'm trying to quantify and think about how I factor that into my thinking. I'm trying to figure out exactly what the inflation story coming out of China may look like. It feels like we're in a bubble surrounding the Fed and the ECB at the moment, but there's lots of other things going on around it. What does the other tail look like to you?
It's a great question. I think your previous guest said, markets struggle to multitask, don't they? And at RBC, we have a great geopolitical analyst in Halima Croft, and she has been very attuned to what's going on in the Middle East. I mean, I heard Jumana earlier, who's a close friend from London days. And again, we've been following that very, very closely because there is a significant risk there of escalation. It's not really reflected in oil prices at the moment. But if that were to pan out, then again, that would be inflationary, that supply-side shock that we're not focusing on
We've got strikes as well. We've got other things that are going on. It does seem as if the inflationary side of the kind of the pro-inflationary side of the equation is growing at the moment, but the market doesn't want to look that way.
Well, I think we've been burnt before, right? It wasn't so long ago that people were looking for rates to get to potentially 6%. It was a trade that didn't really pan out. And so I think people need to see more evidence that it's actually happening rather than trading the what-ifs.
A lot to digest there. We'll see how it all shakes out. 37 days to the election and plenty going on. As Guy mentioned, the rail strikes between the Elsa Lignos, global head of FX strategy at RBC Capital Markets, joining us around the table. Coming up, we go from the macro to the micro. Covestro shares are seen rising over a buyout deal with Abu Dhabi's main energy company. This and your other stocks to watch coming up next. This is Bloomberg.
Welcome back to the programme. 7:42 here in London, so 18 minutes until we start trading here in Europe. And European equity markets suggesting a bit of upside, not a huge amount, but a little upside at the start of our trading day. Let's just get to some breaking news. Confirmation of that Adnoc Covestro deal that we were talking about a little earlier on. Our sources have been telling us that this was coming. So Adnoc has offered to buy Covestro for €62 a share, closed at 55.94 yesterday. So there is some upside perhaps at the start of the trading day. They are saying that the Covestro share capital will be increased by 10% upon completion. And our story also points out that it looks as if Abu Dhabi approval and sign-off has been received here. So that's at least one part of the, one tick in a box.
Well, how do the Germans react to this? I'm assuming this is something that's been well telegraphed and understood in Berlin in a way that maybe the Commerzbank deal wasn't.
Yeah.
Which came as a surprise. This has been a long time in its gestation, and everybody in Berlin's clearly got comfortable with the idea.
Well, perhaps, and we're getting more headlines here. Covestro is signing an investment pact with Adnoc until the end of 2028, but they won't propose a dividend payment until the deal is actually completed. So we'll see how that shows up in the opening trade. We do, however, had already seen on TradeGate pricing that we're seeing a pretty positive read-through into Covestro shares. Yeah, we'll look for if we get any commentary then, as you say, from the German government, which would be interesting. But it does seem as if they have completed all the due diligence on the Abu Dhabi side. So that has been forthcoming, and that
has come through, and that seems to have been completed back in August. So, as you say, there has been quite a long build-up to this story. But, I mean, that's one of the stocks that we're watching at the start of trade. Plenty of other things for us to watch as we get, busy into the trading day. And one of them comes out of France, doesn't it, Kriti? We are watching for Michel Barnier, the Prime Minister, to make his first big address to Parliament since taking on that role. He now comes with a complete cabinet, but does he have a plan for the budget?
And does he withstand any sort of no-confidence push that you get within it? Yeah. To me, I think the most fascinating thing, I know we're talking about budget and the immigration issue, is actually the taxation policy. And we talked about this yesterday as well. There was a report over the weekend from one of the French newspapers that was an 8% rate. It could be potentially even higher.
So you look at what is happening with UK business confidence right now. Yeah. Very low levels, incredibly low levels, and we're back to kind of trust levels, according to the IOD. You think about, it's a similar story over in France. We don't know yet here in the UK what business is going to be taxed at. French businesses are facing exactly the same issue. What kind of impact is it having on investment and confidence and the kinds of things that matter, employment? Are we going to see a similar kind of effect into business confidence in France?
And there will be different decisions made by different governments around the world, but many of them will be facing the similar problem, which is how do you rebuild, financial coffers? How do you rebuild fiscally after the pandemic? We're still dealing with the long tail of that. Let's talk about what is moving markets this morning, Tuesday, 7:45 here in London. Joining us now, our Markets Live executive editor, Mark Cudmore, to give us a briefing on the markets in 3 minutes. Mark, good to see you. Anything new for you from Lagarde and from Powell? At the margin, they seem to be giving slightly different signals in terms of the likelihood of rate cuts or the scale of rate cuts to come next from each of those big central banks. But any other big messaging?
They're definitely giving very different messages. I'm not sure if it's particularly new. I'd say, if anything, in fact, Lagarde is probably the slightly more new one, where she has definitely turned a little bit more dovish over the last weeks or months. But I think the interpretation of Powell yesterday of being hawkish because he said it will take time to return to neutral is probably a little bit overdone. It's related to the fact that we've just priced in such an aggressive amount of rate cuts that will only be justified if there is some kind of severe crisis on the horizon. That for any kind of news flow, the starting point is we're asymmetrically skewed for rates to go higher. It does not mean that yields can't go a little bit lower if we get very bad news. For example, a very negative jobs report this week. Of course, yields might return to the recent lows, but they can't go much lower because we're already pricing in crisis time in the rates curve, which means the natural trend without news or with neutral news is for yields to keep drifting higher again.
Mark, you're pro stocks, you're quite bullish. The question is, how much volatility do you think that comes with right now?
Rather than the volatility question, it's about rotation, I think. And one of the things I want to emphasize, as you know, I've been very bullish stocks all year. I don't think the value is in the US stocks. I'm not bearish US stocks. This is not about a negativity about US stocks. But our colleague Cameron Christ wrote this excellent piece yesterday about a lot of the reason US stocks have done so well for the last 15, 16 years. The US exceptionalism was there was no alternative. Well, you know what? If you start believing in the China story, there's a bit of a turnaround. There might be an alternative, not just in China stocks, not just in Hong Kong stocks, but all the derivative trades. EM stocks around the world are still very discounted, very under-owned. So we might be at the early stages, which we've probably seen in the last couple of months, not just with the China stimulus last week, which gave it a kind of nitro boost. We might be at the early stages of rotation a little bit away from US stocks to the rest of the world that is massively discounted on a relative basis. Again, this is not about being bearish US. It's about, if you're bullish, there's other places to look outside the US.
Does that dynamic turn if we get a Trump presidency, a Trump 2.0, that U.S. exceptionalism that you point out, does that continue as a more defensive trade?
It's a great question, Kriti. I don't know. I'm struggling to work out what that'll mean. I think at the moment, markets, it's such a close election, and we're so unclear about exactly what policies will be enacted. It also depends whether which way the House goes as well, that I think that that's not yet affecting markets, and I'm kind of delaying the analysis there. There's a risk, as you say, it kind of doesn't persist or it goes into a more defensive iteration. But until the election, I think it remains bullish for global stocks outside the US. US is the volatile sector. It'll probably go nowhere overall.
Certainly something we're going to be keeping our eye on. 37 days till the election. I can't realize how quickly it came upon us. Bloomberg Markets Live executive editor Mark Cudmore joining us this morning. You get more up-to-date analysis from him and the team. Just type in MLIV GO on your Bloomberg terminal. Let's go from the macro to the micro. Get our stocks to watch with Joe Easton. Joe.
Morning, Kriti. So we got another big share sale for Haleon overnight. So Pfizer is offloading around £2.4 billion worth of the company in the latest share sale from them. Now, remember, this was the firm that was spun out of GSK. It was a joint venture between Pfizer and GSK, spun out back in 2022. And it's a good time to be selling this stock. We can see trading at a record now, up over the 3-year period since that spin-off, around 27% in terms of that gain. So that will be one to watch today. Now, we've just got the pricing coming in. It's priced at $3.80 a share. We can see it traded at $3.93 almost at the close yesterday. So a bit of a discount that could potentially weigh on that stock today. Worth keeping an eye on Pfizer in the US later as well, of course. Then we're also looking at European banks now. Morgan Stanley downgrading the sector today in a note. Now, they're warning about a weakening economy. They're looking at the PMI data, which they say points to softening of the economy, and also the fact that interest rates are likely to fall faster than they expected, and both of those things should weigh on net interest income, according to the bank. Alvaro Serrano from Morgan Stanley saying that he finds it difficult to see how European banks could continue to outperform from here. And here is the outperformance that he's been talking about. We can see that gap between the Stocks Banks Index and the Stock 600, but he reckons over at MS that outperformance will start to narrow due to the pressure on net interest income. So keep an eye on the banks today in terms of a sector in focus. Then finally, the big M&A news, which has just broken. We did have a Bloomberg story on this last night, and we've just got confirmation that Adnoc has done a deal for Covestro. Now, this is the German chemicals company, of course. This is something that's been talked about for quite a long time. We can see Covestro shares rallying as that M&A news continued over the past year or so. It's been a long-running affair, but Abu Dhabi's national oil company has sealed the deal, and the price for this one, which has been hitting the terminal a moment ago, is €62 a piece. We can see it closed at 56. So again, we will see a bit of a difference in the pricing this morning. That one is set to rise. Keep an eye on Covestro as that takeover deal is confirmed.
Joe, thanks very much. Our equities reporter Joe Easton with an update. Quite a few stocks to watch them this morning. Not earnings season, but still some M&A to talk about, and some sales of stakes, keeping us interested in those stocks. We are going to be going in the next part of the programme over to Berlin for that global dialogue that's taking place there. Really important conversation with Larry Fink, Francine on the ground for that, and a lot of the themes we've been talking about already this hour, no doubt coming up in that conversation, to do with China, the growth story there, US politics, Fed policy, trade, investing in infrastructure, investing in Europe, perhaps, as well.
Well, this push for infrastructure is the one that really gets me. If you look at the private credit universe, the most juicy deals are coming from infrastructure, and it's private capital filling the gap. It's something that we've heard reports that Giorgia Meloni has been courting BlackRock's Larry Fink to actually garner some of that investment and almost steer it towards Italy at a time where they're also struggling to spend in their own country.
The US has been pushing hard. The IRA was a big part of this narrative. You juice the supply side of the economy, you deliver that for the long term. But there's also the AI trade in all of this as well. You think about what is happening with the AI trade. You've now got large tech companies effectively doing their own infrastructure deals. We're restarting nuclear power plants because server farms require more energy. It is so fascinating to see that this is the missing piece in the puzzle. You also come to the UK and look at the dire state of the infrastructure here, how the government needs to figure out a way of juicing that again. How do governments do this? How do tech companies do this? How do big firms like Larry Fink, led by Larry Fink, do this?
Yes, absolutely. And in terms of competition for that money that he has to deploy, to put to work, you mentioned he's talking to Meloni about investing in Italy. Other media reporting that he's also expected middle of this month here in the UK. 2 weeks before the budget, so not sure what clarity we'll get on all of the way that the UK economy is going to take shape, but certainly a focus on UK investment at that particular time.
It's a fascinating one because I think Larry Fink is one of those people who, outside of BlackRock, and with the backing, of course, of his firm, has a kind of tone-setting image in that he was one of the very first people who said that the AI boom that you actually could see could affect the labor market. And that was a connection that I think a couple years ago nobody would have really made when we started to hear about AI as well. And then everyone kind of hopped on that bandwagon, for lack of a better term. But this idea that Larry Fink could say, hey, look, Europe is looking really good right now. We should invest in those infrastructure deals. It kind of opens the floodgates to a lot of that money, to your point, not just in Europe, in the UK. And I'm curious whether that extends to Asia as well.
Yeah, how much are we actually going to get out of the UK? comes 2 weeks before the budget. Are we really going to want to be committing?
Might be lacking on a bit of detail.
Yeah. Timing is.
They need to save some rabbits, or so some cliche goes, to pull out of hats. You know, rabbits out of hats. That's what they typically do on budgets. It's, you know.
Magicians.
Yes.
OK, we're going to be... Francine's got this conversation with Larry Fink. I'm genuinely fascinated to hear what he has to say. BlackRock CEO and founder joining us in an exclusive interview. She's going to be speaking to him at the Berlin Global Dialogue Forum. That is going to be coming up very shortly. There's lots to talk about as the run-up to the market open this morning. Have you seen French car sales this morning? Really dire.
Yeah.
We've also got this vote. Is it tomorrow? We've got this vote coming up. The European Union's going to decide on whether or not it wants to impose EV tariffs. The French seem to be behind that, understandably,
We're going to talk autos in the next hour. We have a guest coming, don't we? I mean, difficulties in China for some, difficulties in the United States for others, supply chain complexity for some of these manufacturers, just a whole host of issues for the sector.
Keep an eye on Adidas and Puma. You were talking about them earlier. Nike's going to be out with numbers a little bit later on today. Those numbers are expected to be quite bad. So in the front-up to that, I think you could be paying attention to that story. Plus, I think there's a downgrade on Caring this morning. So maybe that China luxury trade runs into a little bit of steam. Anyway, market opens next. This is Bloomberg. Tuesday morning, good morning. Couple of minutes to go until we start equity trading here in Europe, cash trading that is. The outlook from the United States actually fairly favourable. The white line here, Europe, there's the close. As you can see, we get a rally after the European close. That takes us maybe into positive territory here this Tuesday morning here in Europe. We've got a lot of things to think about. We're factoring in the politics, what's happening with the strike story in the United States, and keep a careful eye on what is happening in the Middle East. But the get-go looks a little bit more green today than it has done over the last few days, Chrissy.
Seeing a little bit more positivity, but I'm curious how much of that is a reaction to yesterday, to your point, this idea that we did actually sell into the close and had so much of that pressure in that auto sector. We'll take a look at this. Today, the outperformance is right here in the UK. FTSE 100 futures higher by 0.4%. Your stocks 50 higher by 0.2%. But I think this is interesting. The sentiment is turning, Anna, when it comes to those US futures. It was higher just about 2 hours ago in pre-market trading, and this is really speaking to perhaps maybe what that strike story is doing to risk sentiment over in the States is something we're going to be keeping an eye on.
Yeah, just maybe. Maybe that is what is weakening the US futures picture. Pretty flat right now. Let's have a focus on some of the individual names that we'll watch. Of course, we'll watch any stocks linked to that strike activity because some pricing benefits could accrue to some of the European players in that sector. But we're also watching Covestro. They've got an offer from Adnoc. It looks like Covestro is welcoming and supporting that takeover offer from Adnoc. Haleon is in focus. We have heard that Pfizer is selling part of their stake in that particular business. We're also watching the banking sector. Morgan Stanley analysts downgrading European banks to inline. Previously, they had an attractive rating on this, and they're citing weak macroeconomic data and the fact that the interest rates are coming down in Europe.
So it feels like a single stock kind of morning, doesn't it? Let's take a look at where these market openings coming through. It's time for the opening trade. These are our opening numbers this Tuesday morning. I think we're going to have to look below the surface maybe for some of the action because I think at the get-go we're going to see maybe a fairly muted start to the day. So the FTSE 100 up by 0.1%. The Stock 600 comes through any second now. There you go, up by 0.1%. At an index level, we're not seeing a lot of activity coming through. There's some big macro themes that we need to factor into our thinking. What is happening in the Middle East, what's happening with the strike story in the United States, how does that fold into the central bank story? But the bottom-up story this morning, I think there's a few things that are really worth digging into. The CAC 40 in particular, starting soft this morning. What's going on below the surface, Kriti?
Well, it is the French stocks that are dragging the Stock 600 down lower. Your biggest, from an index weighting perspective, is going to be LVMH right out of the gates, as is Total and Caring as well. It looks like luxury really on the back foot here. Your outperformance, though, coming from a lot of your big tech names. The idea of Novo Nordisk, ASML, SAP, those are your outperformers, alongside some of the biotech names. Perhaps that's where you're seeing some of the green on screen in the FTSE. Yeah,
so consumer products and services, the worst performing sector. As you say, Chrissy, there's a lot of luxury in the mix there. Utilities and energy also not doing so well. Energy was the only sector yesterday that actually gained in Europe. So we're seeing a bit of a reversal of that. And oil prices are a little weaker despite the tensions in the Middle East. 71.51 is where we trade on Brent. So that's the downside. Yes, to your point, Kriti, then technology not doing too badly in terms of the early performance. And food, beverage and tobacco also on the rise. I also saw media was strong out of the gates, but doesn't seem to be lasting particularly.
No, I'm struggling to find a kind of clear line that runs through some of these stock stories. So Fortum's a little bit softer, so the luxury names are down as well. So the energy names are certainly soft. In terms of the points, it is LVMH, L'Oreal that are really doing the damage on the downside. That's where the French market story is coming through. We've had a really good run on the back of the China story. I just wonder whether everybody's looking at that and going, that was nice. Yeah. I'll take a few chips off the table.
It's a fascinating one. A lot of this is going to be positioning as well, coming from yesterday as well. Look, this is all going on the micro front. Let's go back to the macro here. Bloomberg's Francine Lacqua is in Germany at the Berlin Global Dialogue Forum. She's got an exclusive conversation, of course, talking about all things infrastructure, trade, and plenty more on the agenda. Francine.
Thank you so much, Kriti. I am delighted to be joined by the one and only Larry Fink of BlackRock. Larry, thank you so much for joining us. First of all, happy anniversary. There was that prospectus of 1st of October, 1999, where BlackRock went public, so you're 25 years young.
It's great reading, wasn't it? Yeah, I mean, it's a really good day for us. It's our 25th anniversary. It's our day that we are closing GIP, and right around this time, we're going to have our 30th anniversary here in Germany. So it's a good day. I'm very pleased that our stock performance is up, close to 11,000% over that time. Actually, 20 times greater than the S&P. So
but the market has changed so much in that time. I mean, it's amazing. In 25 years, there's a lot more private. There's a lot more credits. You're gone into infrastructure. I'm not going to ask you what the 25 years to come will bring, but what are you most optimistic about in the next 3 years?
Well, I think one of the reasons why our stock has done so well is I think we understood that more and more of the global economy will be moving to the capital markets. And I think all those things you suggested is just an indication of all the movements towards the capital markets. And I think this is going to be broadly a world event. We're seeing more and more countries focusing on their capital markets. A great economy is an economy that has a strong capital markets and a strong banking system. We've seen here in Europe, historically, a strong banking system and a weak capital markets. That's changing right now here in Europe. But in other countries like Japan, you had the Kishida government doubling down their retirement tax deductibility for a product. They have a desire to building out their capital markets. In India, Prime Minister Modi is focusing on retirement to build out their capital markets, to broaden their entire economy. And I think that's the movement for the next 25 years in front of us, a further broadening of the global capital markets, whether that is private debt, infrastructure debt, private equity, venture capital. And I think this is important. And if I look back over the 25 years, one of the strengths that I see is because of the strengths of the U.S. capital markets, the U.S. Influence in the world has become broader and greater than it was 25 years ago. And that is because of the depth of the capital markets.
But in all of this, Larry, where do you find the best deal? So, for example, in infrastructure, if you look at the closure of GIP, it's today. This was a massive play. What does it mean for integration? What does it mean for actually fundraising for infrastructure?
Well, GIP is in the midst of closing a $25 billion infrastructure product. The old BlackRock, our infra team is going to be raising another $10 billion. And then we announced a partnership with Microsoft, NVIDIA, and MGX. We have aspirations of raising $30 billion of equity, and then beyond that, more debt associated when we build out these AI data centers. So to me, this is the dawning of infrastructure. When I look around the world today, I see the inadequacies of infrastructure in almost every country. So we need to be decarbonizing, we need to be digitizing, we need to be moving forward, we need to be building out more and more. And I think this is one of the big issues. As I wrote in an editorial a few months back in the FT and I spoke at the G7, I spoke about every economy needs to focus on growth. There's too much focus on, should we lower taxes, should we raise taxes? Not enough. How do we stimulate growth? And I think infrastructure is a major component of how we stimulate growth. And we don't, because of the breadth of the capital market, we don't have to rely on federal spending or state spending. There is enough capital in the private sector that will be able to fund these new projects. And so to me, this is a dawning of the new reality that we're going to see broadening of public and private investing for infrastructure.
Is there a worry that it becomes quite political? So there are a couple of projects, Malaysia, Minnesota, that have been politicized. Is there a danger that infrastructure becomes a new ESG?
I see a very different outcome of that. This is helping government build out their infrastructure. There is no question, there may be one project or another project that may be politicized for one reason or another. But overall, in my conversations with politicians worldwide, they know they're in need of more private capital. So I dearly hope it's not politicized. If it's politicized in one location, it means money's going to seek another safer spot. And so you always have those type of risks, but capital is free moving, and capital is going to be seeking a safe, sound investment. You know, we are the largest retirement manager in the world. Our job is to try to be finding investments on behalf of our retirees to find safe outcomes over a long period of time. So if there is an event that politicizes it, money will leave and money will seek another destination.
Where does the smart money stay away from? Is there anywhere in the markets where either something is priced to perfection or it's too risky? I know we talk about commercial real estate for,
markets
such a long
move
time.
Up and down. You always see, you mentioned like commercial real estate, you see too much money moving in one area, then it runs away from it. I think that's what markets do. We test the outer boundaries of pricing, and it becomes maybe a level in which that we don't find it's a great outcome for long-term investing, and then money moves to another destination. I think that's a natural movement, so I'm not worried about one area versus another area. The one other thing that I think everybody asks me is, you know, is the market so pricey and yet all this geopolitical issues? I would argue today, because of the expansion of the global capital markets, we're diffusing more risk than ever. There is actually less systemic risk today than ever before. You mentioned private credit. Private credit is chiefly matching a liability and an asset together. It's not leveraging 8-to-1 like in a banking system. That's a good example of diffusing some systemic risk. But as more and more capital's broadening out how they invest, where they invest, that actually reduces less concentration in one area. Of course, we've seen, especially in cities, a decline in commercial real estate, but that's a natural process. But there's nothing systemic about it. You may lose money on one building, but you're moving into other destinations like data centers. You're moving into different cities that may have rising population growth. But you know, you can't fight demographics. So there's some cities that are shrinking. Obviously, commercial real estate in those cities are going to be declining with that declining population.
Larry, what's your play in private credit? How much bigger do you want to be? How much do you want in this space?
We have large aspirations, as we wrote about it last year, and we continue to be building out a private credit area, and there's more to come. We're very excited about our position. If you just think about the role of infrastructure debt, if you think about what we announced with MGX and Microsoft, raising $30 billion of equity, but we're going to raise $100 to $120 billion of debt associated with those data centers. So I actually believe as we move out and building out more and more infrastructure investing, you're going to see more infrastructure or private credit associated with that. And so that will also represent a great opportunity that you know, you have a hyperscaler like a Meta, like a Microsoft, like an Amazon, you have their credit that you're going to be able to leverage it up and provide returns, stable returns over 15, 20 years, because that's what those leases will be on these data centers. And so you have a great opportunity for long-term investing.
Larry, on the U.S. economy, and we talked about U.S. exceptionalism. Do you worry that actually there are two very different outcomes with the U.S. election that could bring the economy in different ways?
Both candidates have, in many cases, very similar views on making the U.S. even stronger. Both candidates, in their interpretation of how that may happen, may differ. Our job is to work with any political position. Our job is to be working with the U.S. government, like we're here in Germany. We're working with the German government. There's going to be an election here next year, too. Our job is to be working with societies and building a platform together, and so we're not trying to make any judgments.
But you deploy capital differently under President Trump than under President Harris?
On the margin, not
that much?
No, I think we over-conflate what it means. I mean, I don't think the U.S. is going to be pivoting that much depending on one outcome. You know, we're not focusing on the day-to-day movements of markets. We're focusing on, is the U.S. an exceptional place to invest for 5 years, 10 years, 20 years? That's what we're focusing on. Yes, there may be moments where you could have a 10% or even a 15 or 20% downdraft. Does that represent a major shift, or does that represent an opportunity? And so you have to look at it that way. In most cases, over the last 30 years, anytime you had a 10 or 20% downdraft, you wanted to be there standing by and buying. And those who ran away over a 20-year horizon have lost a lot of possible return.
Are you optimistic about Europe? So you're one of the biggest shareholders in UniCredit. You're one of the biggest shareholders in Commerzbank.
Yes.
Does a combination need, does it make a bit of impetus for Europe? Does it make sense?
I am a very large believer on a banking and a capital markets union. I think that's the strength of the United States. Europe needs to do that. I've read the Draghi report. Because we are large shareholders in both, I don't talk about any activity about one organization versus another. But technically, I look at the strength of the United States, and much of the strength is because of the strength of our capital markets and our banking system. Europe needs a stronger capital market system, and it needs a more unified banking system. And I think that's going to be urgently necessary for Europe to go to the next step.
So as a shareholder, you don't get involved? Or have you spoken to the chief executives?
I'm not going to talk about it. And two, I don't do any of the voting at BlackRock myself. That's not my responsibility. Let me just say, I speak to a lot of executives on this. I speak to a lot of politicians on these matters. And that's between me and the politicians.
What's your take on China right now?
I would have said before these Chinese actions of last week in terms of the massive fiscal and monetary policy shifts, China was going from bad to worse. I think they recognize now that their economy was descending quite rapidly. There was a lack of confidence. And I think we're going to have to wait and see, is this enough to stabilize I would say, the failings of confidence. As I spoke to more and more executives in China, there was a fear that, we haven't found the bottom yet. Could this be the bottom for China? I think systematically you're going to see more and more companies diversifying their supply chains. And you're seeing that. You're seeing India as a great destination. You're seeing Philippines and Vietnam as great destinations. Closer to the United States, Mexico has been an incredible destination for more and more manufacturing. And so that's not going to change. We are going to see a systematic change in how we manage supply chains. I think COVID taught us a lot of lessons on two large dependencies. And with all the disruptions of supply chains, everybody's waking up to, we need to have a more resilient supply chain. Before COVID, we talked about we need the most efficient supply chain. When you have those issues, efficiencies didn't work, and we had real big disruptions. And every company's focusing on a broadening, a more diversified supply chain, so you don't have these type of disruptions. And that's going to be a downdraft for China. So that will be continuing.
Larry, you seem very bullish about, I guess, the next 2 to 3 years. But there's a lot of, there's China, there's a lot of unsettled politics, there's AI, which I know you're playing through Microsoft and data centers. Is there anything that unsettles you that the world is living through?
Look, I think every moment it's unsettling. The war in Ukraine, which we haven't talked about, is incredibly unsettling and very destabilizing for Europe. The war in the Middle East right now with Lebanon and Gaza is very unsettling. At the same time, as I said, we are broadening the capital markets. Even with these type of disruptions, we're not seeing disruption in the energy market. And we're seeing more diversification, and so the markets are able to overcome some of these. Now, if they create more supply chain disruptions, they create supply chain disruptions for energy, that changes the whole ecosystem. But right now, I don't see anything that really, to me, is going to be disrupting this tremendous momentum. The amount of trillions of dollars that are going to be necessary for infrastructure investing is going to be vital to uplift the economies worldwide. And this is why I'm still, urging more and more economies to focus on growth, focus on how to build out their infrastructure. That will lift up the economy and create great jobs.
When you look at the U.S. economy, you're expecting a soft landing? Or is there a danger, actually, that we get...
I don't see any landing. The economy is going to continue to grow at 2 plus 3%. I don't even know why we use a landing. Landing last time means it goes to zero. It goes, you know, I know we use those words. It's really fun to talk about.
But it's not going to crash.
I've been very consistent. We're not going to have a hard landing, but I don't want to see a soft landing. We're going to continue. We're continuing to move and navigate it. But despite all that, there are segments of the economy that are struggling. There are segments of the economy that are doing really well. We spend so much time focusing on the segments that are doing poorly, and I'm not trying to suggest that's not the right thing to do, but we're not looking at it in the holistic way that other parts of the economy are doing really, really well. Look at corporate earnings overall. They've been very strong, and I think they're going to continue to be very strong. We have, we do have segments of the economy that are very strong, and I think that's why I don't know why we talk about a hard or soft landing. We're continuing. We're going to grow at 2 to 3%.
It's the Fed watchers. Blame the Fed watchers because they're all...
Who are they? I don't follow them. By the way, let me just tell you one thing. Right? Let me just tell you, I think the forward curve is wrong. Okay. We're not going to see, and I think Chairman Powell said that yesterday. We're going to be patient as we. I think the amount of easing that's in the forward curve is crazy. I mean, I do believe there's room for easing more, but not as much as the forward curve would indicate.
And this is what, a flaw in the markets, a flaw in perception, analysis, or
markets move. They have to readjust, and I think yesterday was a small readjustment. I mean. I don't look at this as a problem. You're talking about the tick-tock of the market. I don't spend any time on the tick-tock of the market. I'm aware of it, but I'm not, whether it's, the Federal Reserve eases another 100, 150, we'll see. We'll see. I mean, I think I see more policies by more government that tend to be more inflationary than deflationary. And so with that in mind, it's hard for me to see another 200 basis points of decline in short rates.
I'm going to use that. The tick-tock of the market is fine, but secondary. Larry, as always, thank you so much for joining us. Larry Fink, BlackRock Chairman and Chief Executive. I'm going to send it back to you in London. We'll have plenty more throughout the day from Berlin.
Francine, thank you very much indeed. Francine Lacroix at the Berlin Global Dialogue Forum, speaking to Larry Fink. The forward curve is wrong. And we're not going to get a landing. We're going to get a slowdown, but we're not going to get a landing. Stop talking about a soft landing. It's not a landing. A landing implies that we get a zero.
For me, it was more policies are inflationary than deflationary. That is not music to Chair Powell's ears.
Yes, he was sort of talking globally, wasn't he? But then he did bring it back to the curve and to expectations there. Yep. I guess it's another way of him making that same point, that the market is expecting too much in terms of cuts. Doesn't necessarily mean that the direction of travel for the Fed changes. Maybe just means they don't cut as much as the market is expecting.
The forward curve is wrong. He wanted to get that point across.
He came back to that one.
He wanted, but a lot of people are saying it. Yeah. The tails on inflation are pretty fat right now. Yeah. And you look at what is happening around the world today, striking the United States on the East Coast, what is happening in the Middle East at the moment, the potential coming out of the US election, all of those things still exist. So, yeah, he is certainly paying attention. He's not paying attention to the tick-tock of the markets, but I think Larry Fink is definitely paying attention. Let's pay attention to what is happening with the core six right now. This is what the picture looks like across Europe. Kriti was talking a little bit earlier about what's happening with some of the pharma stocks. They are doing well. You can see that on the left-hand side there. But luxury is under pressure. We've got a downgrade on caring today. We've seen a decent performance over the last few days. That is unwinding a little bit today. Tech looks like it's on the front foot as well. Let's figure out what is happening with some of the other single stocks.
Absolutely. So those are the core six. Let's go to the other movers. There's been plenty of news flow to keep Joe Easton busy. Joe.
So one stock keeping us busy, Anna, is Covestro. That's the big M&A story of the day. Abu Dhabi National Oil Co. sealing that deal for the company. But it doesn't look like we're rising up to the bid price at the moment. It is trading below that. Maybe that's telling us something about some execution risk on that one. But it is the German chemicals company, one of the best performers on the stock 600 today as they announced that big deal. It was reported by Bloomberg, of course, last night. And then we've got a statement, an official statement on that today. But the stock heading up around 4% over in Germany. Then going the other way, we've got Haleon, the maker of paracetamol, and Advil coming down 1%. Pfizer offloading $2.4 billion worth of the stock, putting that through the shares this morning. So it is weighing on it. It was at a discount, so we're coming down again, not quite coming down to the actual price of that, but it is a chunky sell from the firm and the long list of sales in terms of offloading some stock in that. Then we got Greggs, a shocker. It's a Greggs update, and it's actually not that strong. Greggs is normally one that keeps putting out really strong results, but actually the sales have started to weaken. They are very excited about their iced pumpkin donut. They do mention that in the statement, but that's not enough to lift the stock this morning. We're coming down 5%. Jeffries is saying in a note that, in fact, it is a bit of a remarkable slowdown from the year-on-year period. So that is weighing on Greggs this morning. Bit of disappointment there. Then in terms of Vestas, another one that's a bit disappointing. They had some orders in terms of wind turbines last night. This is over in Denmark, the biggest maker of wind turbines around the world, and that one is weighing on the stock today. So that one's coming down 2.4% this morning. Then we're going to look at beer, because one of the big broker moves this morning, we've got AB InBev, the maker of Budweiser, of course. Now, remember, there was a big slowdown in the Budweiser volumes on the back of a bit of a social media storm last year. Now, Citi does not think that Budweiser sales will recover to previous levels, but they say the margin outlook is improving, and that should actually help to expand their profits in the year ahead. So they recommend buying that one. That one's gaining 2% as Citi upgrades AB InBev. And as Guy mentioned earlier, in the luxury space today, Kering comes down to sell. That one falling 2.6. This is at Goldman Sachs. Goldman had a note on the luxury space around a week ago, and they did warn of weakening sales across that space, as a number of banks have done, and therefore they're now downgrading Kering as well. That one declining today. We've done luxury goods, sausage rolls and also beer. So we've hit all the bases. Kering coming down 2.4% this morning.
Joe Easton from our equities team, we thank you so much for giving us the roundup and making us slightly hungry in the process. In the meantime, let's bring you some live headlines coming out of Brussels at the morning. It looks like Mark Rutte, the former Dutch Prime Minister, now going to be the new Secretary General, officially taking over the reins from Jens Stoltenberg. He's making some comments over at NATO HQ, saying they will be able to work with both Trump and Harris, but emphasizing the need to invest more and close capability gaps. And of course, this is something we had heard from just Larry Fink as well, talking about more infrastructure spending as well, and just, again, the need to invest in Europe. We hear it over and over again.
The need to invest. We also heard from Draghi talking about this as well. That was one of his key planks when he talked about his plan. Europe needs to invest in its own defence capabilities. The question is it a zero-sum game? Can you spend here and still spend over here, or if you're going to spend on defence, do you need to maybe take away some of the money from elsewhere?
And how do you do it with the fiscal handcuffs that are, I think, the issue plaguing several nations? France, of course, top of that list. French Prime Minister is where we go next. Michel Barnier is reportedly planning to raise up to 18 billion euros as he looks to regain control of the country's finances, according to the Le Parisien newspaper. He will also push back a budget deficit target ahead of his first policy speech to Parliament later today. Let's get the details with Eleonora Mavariti from Bloomberg Economics, based in Paris for us. Eleonora, walk us through some of these negotiations. How much will what we hear from Michel Barnier actually change, perhaps, the way this budget is interpreted?
Well, France is currently in a very challenging situation. The debt to GDP is very high, it's over 110% of GDP, and the deficit is huge. Now the new government will have to make ends meet and propose some fiscal consolidation to meet with the EU rules. What would that mean? What we estimate that means is 0.8 percentage points of increase in the primary deficit annually for the next 7 years. So that will be approximately close to 25 billion of extra revenues or cuts annually. That needs to be sustained every year. This type of consolidation,
So, Eleonora, that's the budget challenge. What about the role of pension reform then? That's often talked about as something to watch when it comes to the French budget and getting it under control. Are we going to reopen conversations about that?
Well, it's not unlikely, given that both the two main opposition parties have revealed they would like to reverse it if they were in power. But we think that that's a risky move. The reform has increased the working aids, and also accelerated the increase in the years of contributions, and it was supposed to have positive impacts both on the fiscal side, but also on the potential growth of the economy. Reversing it, we estimate that can have both impacts on the fiscal side, but also on the labor force. And the fiscal side will decrease the fiscal revenues significantly, and we see that we estimate by 2050 it can increase the debt by 15 percentage points compared to our baseline. And in terms of
Eleanor, thank you.
GDP impact.
We'll have to leave it there. Eleanor, thank you very much for joining us. Eleanor Mavroidi from Bloomberg Economics. Thanks for the preview. We'll keep an eye on Paris, keep an eye on what we hear from Michel Barnier and whether he says anything that moves the spread of French bonds. Coming up, we'll talk about the consumer. eBay UK announces major changes as it attempts to take on competition from the likes of Vinted and Depop. We will speak to the general manager for the UK of eBay. This is Bloomberg.
This is the opening trade. We're about 30 minutes into today's session. You are starting to see risk sentiment turn around a little bit. You're seeing Stoxx 600 basically flat. The underperformer here is going to be those French stocks. That's where you're seeing a lot of the weight come down, although still green on the screen when you look at the FTSE 100 and the DAX as well. But those French stocks really taking the wind out of the sails in the broader Stoxx 600.
And we've got that big announcement coming out, that big speech coming out from Barnier a little bit later on. We'll see what he has to say. Spending, taxes, all in the mix. Pensions, we'll be focusing on that 2 p.m. London time for that Prime Minister Barnier speech. The other story we're focusing on this morning is what is happening with the inflationary picture around the world. One of the big pieces of that is what is happening on the east coast of the United States. European shipping stocks firmly in focus this morning. U.S. dock workers walking out of every major port on the east coast of the United States, plus the Gulf Coast for the first time since 1977. We're back to the 70s. Let's tell this story with Bloomberg's Brendan Murray. Now what?
Well, now that the attention turns to the White House, the two sides are still very far apart. The union put out a statement shortly after midnight, New York time, that said the wage offer is nowhere near good enough, and they're also concerned about automation. Not just their livelihoods, but their existence. So the two sides are very far apart. They haven't talked since June, so something's going to have to give. And the White House, the Biden administration, a lot of businesses are looking at the White House going, you got to step in and end this thing before it drags on for too long, because the economic damage is piling up. $1 billion to $5 billion a day. 75,000 containers a day go through these 36 ports. That's 500,000 a week. Before you know it, we're looking at a major congestion problem with all the inflationary implications, delays around the holidays.
Yes, so that takes us on to the impossible question, which is about the impact on the economy. And I say impossible because you set up the stakes, but depending how long this lasts, that has a real impact on how much disruption we see to the economy and how much, I mean, some of the activity will just be delayed, but some of it will be lost.
Exactly. So a couple of days, economists say, we're not going to see a huge dent to GDP. But if you start getting into, it starts depressing consumer sentiments, consumer purchases. The New York governor yesterday said nobody needs to panic. There'll be plenty of things on the shelves, which kind of, begs the question. Maybe I should be worried about that if these ships are going to be waiting in the dozens or even hundreds for weeks or more.
Because I was reading in the story, sorry, could you just jump in, that 35 ships that are due to be arriving in the next week, and they just go to Anchorage. They just sit off the coast.
Now we know where to get our groceries. I want to ask about the political implications here, because in the last 18 months, this is not the first labor movement that we've seen. We've seen it in Hollywood. We've seen it in flight attendants. We've seen it UPS and, of course, rail strikes. And each one of those times, to avoid the inflationary uptick, Joe Biden has intervened. It doesn't look like he's going to be doing it this time around. Is it as simple as not trying to lose the labor vote in this election? Yeah, I mean, the timing, we're 5 weeks today from the election, so the timing is very important here. He's at the moment, he's sticking with his I'm not going to intervene stance, but we'll see how long he can hold on to that. At some point, trying to protect the union vote is going to turn into the general public going, this is causing a problem for all of us. So we'll see how long he can hold out.
in supporting the union. At some point, something's got to give. Otherwise, the broader economy is going to suffer.
The shipping industry's got very good at being flexible over the last few years. The latest, obviously, is what is happening in the Red Sea. They go around South Africa. This is another element of the need for them to be flexible. Can they go elsewhere? Can these ships be unloaded elsewhere? What does congestion look like elsewhere? Is there capacity elsewhere? Canada's also on strike.
We're going to be keeping a close eye on what ships do over the next several days. At the moment, they can't really go anywhere else. It's too expensive. It takes too long to go to the West Coast. The West Coast ports are already pretty much at capacity, so there's no time savings, and certainly there's more cost to go around through the, you got to pay to go through the Panama Canal. Yeah. So it just adds cost. So at the moment, the shipping industry will kind of decelerate. We'll try to slow everything down so the bottleneck doesn't get so big, but the longer this goes on, the longer they will not be able to do that.
And Brendan, interesting that we're seeing European shipping companies down today. That is in the context of gains yesterday, though. Are markets going to price in higher pricing power and focus on that, or are they just going to say this looks disruptive? That's not good.
Yeah, you could read that as the strike is underway, and hopefully there'll be a resolution sometime soon, and we won't see a big increase in freight rates that would benefit the shipping lines. So yeah, we'll see how it plays out.
OK, Brendan, thank you very much. Thanks for joining us. Our trade czar focused on supply chains globally. Brendan Murray, thank you for being with us. So if it's going to take longer, or if global trade is going to be disrupted to get things in from one part of the world to the other, then maybe you find other places to shop. eBay UK has removed fees for private sellers across all categories starting today. It comes after the e-commerce giant cut fashion selling fees earlier this year to compete with the likes of Vinted and Depop. Joining us now is Kirsty Keoghan, who is General Manager of eBay UK. Kirsty, nice to speak to you. Thank you for coming to talk to us. So let's first deal with what it is you've said you're doing today. Why are you removing these seller fees? What's been your experience of doing that elsewhere?
Yeah, so it's a historic day for us in the UK because we've really changed our business model, and it means previously there were fees associated with selling items on eBay, and today it means that now if you sell items on eBay, what you sell them for, you pocket all of that cash. You sell something for £20, then you pocket £20. And that was a big barrier for consumers paying fees, so we've removed that. We've also made it easier as well. So we've made it quicker to list. We've created tools so you can take a picture and remove the background. Right. We write the listings for you, made it easier and safer to shop locally. So we've really listened to our customers and tried to roll out as many changes to make it as easy as possible for people to embrace a circular economy. OK,
and what do you find about when people sell more through you, do they also buy more? Because I also noticed you're bringing in this eBay balance function where you can keep your money on the site. I mean, you're trying to find more ways, I suppose, for people to not take the money that they make on eBay out of the eBay environment and to spend it with you as well.
Yeah, so we know that customers, or if you sell on eBay, you buy twice as much on eBay. And one of the pain points for customers, that for some customers, was that money that you would make when you're selling your items would go straight into your bank account. For some people, they'd rather store it up and save it to buy. It could be Christmas gifts, perfect time coming up, or it could be they want to buy other things
it in their bank account.
Or exactly. And so we just wanted to give customers that choice.
Right.
Is this a response to Vinted? I'm not the prime candidate here, but my kids, I know people who are involved in this process. Yeah. And it's quite competitive in terms of where you list stuff. Is this a competitive response, or is this a response to removing friction from the system?
Yeah, I mean, look, eBay's been around for nearly 30 years, so we're always having to change and adapt to what our customers want. And this really is a response to what our customers have asked for us. So, removing the fees, making it easier, and that's why we've made this move here in the UK.
How would you define consumer confidence at the moment? Kind of, what are you seeing? What are people buying? Is there a change? Is there a shift underway? Is there anything we can discern from what you see on the eBay site about, is it glass half full out there for most people or glass half empty?
Again, it is mixed, but there's a lot on customers' minds at the moment. So people have got less money. People also want to shop more sustainably and make more responsible choices. And so that's why shopping on eBay is a great way to buy into pre-loved or refurbished goods. So 40% of our GMV now globally is from pre-loved or refurbished goods. But it's also a great way for customers to make money as well. So we know, up to 50% of households are sat on lots of unused items. I'm the same. I've got lots of them. And the average consumer, the average household will have about £300 worth of items that they're just not using. So they could sell those, make some money, and also put those items into another home where someone's going to love those items.
I love getting rid of stuff.
I don't. I like keeping everything forever. Guy made the comment or compared it to Vinted. I'd like to compare it to perhaps Amazon as well. Where are you seeing the competition? Who are you up against here?
Look, as I say, we've been around for a long time, so we've always had lots of competition. And what I do love about what's going on with the competitive landscape is at the moment is it's encouraging more people to shop sustainably and not putting stuff in landfill. And so we look at all of our different categories. So we sell car parts, so we have a fitment service. We look for luxury shoes and handbags. We have an authentication service. We try to do the best we can in each of our categories and deliver an amazing experience for our customers.
So how do you bring the prices down further?
So ultimately, we don't own any goods. That's down to our marketplace. So we just try to make sure that we give as much sort of coaching and all the tools that we can give to our customers about what items are selling for.
But from a private seller, you've removed the fees now.
Yeah.
Is there a next step that you guys are looking towards?
For private sellers?
For private sellers, for the consumer, how do we bring that listing price lower?
So ultimately, if there's no fees, then it's up to the consumer if they want to sell that item for less. But ultimately, we just want to get more listings on, and that's why we've made it easier. So rather than listing 1 or 2 items, because it might have taken you a longer time before, we've removed some steps to make it easier. So hopefully you're more encouraged to go and clear out your wardrobe, or if you're moving house, go and sell all those things on eBay. As I say, rather than go to landfill.
Less is more. Get rid of it. Get it out of the house. Firmly in favour of that. Kirsty, nice to see you. Thanks for stopping by to see us. Kirsty Keoghan, General Manager, eBay UK. Thank you very much indeed. Talking of car parts, we need to talk about what is happening in the auto sector right now. Harald Hendrikse is going to be joining us, Managing Director of Auto's Research at Citi. Is going to be coming up next to navigate what is a bumpy road for the auto sector right now. Have you seen the car sales data this morning out of France? Again, super weak. We'll talk about that next. This is Bloomberg.
Welcome back to the opening trade. We are 44 minutes into a European trading session that shows modest gains. We weakened a little just half an hour ago, but actually back into positive territory only just on the stock 600. In terms of what we are seeing under the hood, though, European automakers in focus this week after Volkswagen, Stellantis and Aston Martin all delivered warnings of a bumpy road ahead for the sector. Our next guest says the caution is unsurprising. Harald Hendrikse is Managing Director of Autos Research at Citi and joins us now on set. Harald, nice to have you with us. So take us through, big picture here. There seem to be different issues for different car makers depending on where they're exposed. And what can you tell us that unites them all? For Stellantis, difficulties in North America, VW citing difficulties in China, Aston Martin talking about supply chain problems. What is the uniting problem that they are all facing?
The uniting problem is really that they're all coming from a really high base during COVID. Right? Overall, consumer demand was very strong during COVID. They had production problems, so they couldn't produce, what the consumer wanted to buy. So they had a lot of pricing power for the first time in, literally my career, over 20 years.
Yep.
Car companies have never had that much pricing power. So they were selling very highly priced cars at very, very strong margins. And I think they'd all extrapolated as if that would continue forever, and it just hasn't. So China clearly much, much weaker this year. Because they can't sell in China, they're selling more cars in the US, and so that's causing US discounts to start to go up. And now the last thing is in the summer, clearly orders in Europe have slowed very sharply, right? Europe was up nearly 5% in the first half of the year, was flat in July, minus 17% in August, and then this morning we've had France down 11% in September.
Yes.
So They were hoping for a much stronger second half in Europe, and that hasn't happened.
But putting it in the context of COVID makes it sound like we're talking about some kind of normalisation. But given the move away from, you know, internal combustion engines to EVs, that doesn't feel like we're in normal territory, and that seems to be wrong-footing a lot of people. So is this normalisation, or is there something much bigger?
I think you're right. I think there's two levels. But actually, most of the problems we're talking about today are about normalisation, right? The market in Europe hasn't come back to pre-COVID levels. The market in China is just more difficult than it used to be. And then pricing has just been too high. You know, people forget, but car prices across the world, if you look at the ASPs for these companies, are up 30-35% in 4 or 5 years. You know, our salaries are not up 35%. So, you know, in real terms, people cannot buy as many cars. And so the European market now is sitting at about 13 million units. We're stagnating at 13 million units. Pre-COVID, it was 15.5. You know, we've lost 2.5 million units. If you're a car company, Volkswagen, 26% market share, you've lost 600,000 units. That's nearly 2 huge factories, right? And so they can't fill up the capacity anymore. So the industry is really, really different. And that's even before we go to Chinese competition. That's before we really transition to the EV situation, where, again, that's super difficult. You know, the cars are too expensive. The consumer doesn't want to buy them. The governments have no money for stimulus. How are we going to sell all these EVs, right?
Politicians are beginning to get very nervous. You're hearing that across Europe. Germany is the epicenter of the action. The expectation is that we're going to be seeing some of these targets removed or pushed out. Is that the silver bullet here? Is that going to make much of a difference, or are we delaying the inevitable?
Yeah, really, really good question, and a really, long, hard discussion. We, last week, changed our view from a 30% chance of a change in the European CO2 targets to now our base case is that they will. For exactly the same reasons as you're talking about. I think the European politicians, I mean, we had 2 horrible elections, frankly, in France and Germany for the governments that were in power. I think those politicians are starting to understand that, well, they're going to lose their jobs. So finally, things, I think, are changing. And so I think the first thing will be that the regulations for European CO2 will be delayed to give us a much more sensible, frankly, time frame for the companies to be able to meet those targets. But then, also we need more stimulus. If you want people to drive BEVs, you have to stop them driving ICE cars. Why are there not more city bans, for example? We've got toll roads everywhere.
Because there isn't the infrastructure to go with that. There isn't the industrial policy that wraps around all of this.
Yeah, I mean, look, we don't have a strategy, a total strategy to build.
Just stop there. We don't have a strategy. Maybe that's where we need to be thinking about it.
That's really, really right. But the really disappointing thing, I think, for a European point of view is, we were ahead on the CO2 side. We saw that coming. We were first to push people towards BEVs, and we're not capitalizing in terms of the industrial base. We're not capitalizing in terms of battery factories, investments, all of these things. These companies should be winners in the BEV space, and right now they're not.
How much pricing power do they actually have? If we're talking about targeting American consumers in the absence of anyone else, how much lower can the prices go? Can they at all?
Yeah, you've framed it very nicely. So at the end of the day, pricing is essentially a function of the profitability, right? So if you're sitting at 10, 12% margins, then pricing is a little bit easier, and cutting prices by 3 or 4% is possible. Once you're down to, Stellantis yesterday talking about very low margins in the North American market for the second half of the year, at that stage pricing becomes much more difficult, right? People forget, if you give away 200 basis points of pricing, that's 20% of your normalized, maybe even 25% of your normalized profits gone.
Yeah.
Right? Pricing is very, very sensitive. So I think we're coming up against a situation where it's going to get more difficult, but the overall American market is still getting more difficult. And just to give you an example, before COVID, we were at 13% average discount, dealer discount, for the average car. Today, the average market is still at 7 or 8. So we're not yet at pre-COVID levels in terms of discounting. Given where inventory is, given people like Stellantis and stuff like that, I think pricing could get a little bit worse.
So what does that do to the design cycle and the innovation cycle when it comes to releasing some of these new models?
Yeah, well, so 2 things on that. Firstly, the Chinese are really showing us the way, right? So, generally speaking, the legacy car companies have had, new model cycles, 6 or 7 year, model life cycles, right? The Chinese are down to about 2 or 3 years. So they've really sped things up very, very significantly, and especially with the new technology, software, hardware, electronics going into the car. The life cycle has to be shorter because, the technology gains that they're making in those areas are so much faster, right? If 6 or 7 years is a lifetime, in terms of some of those products. For the legacy car companies, look, it's difficult. Profitability was super high last year. They all increased spending. CapEx and R&D spending is really high this year. Now that profits are coming down, you know, they're going to have to look at exactly where they want to invest, and they may not have quite as much to invest for next year.
Harald, you mentioned how there's not enough industrial strategy in Europe. It seems to get a lot of mention. We talk about it a lot, and we live in a much more geopolitically interventionist world with the Inflation Reduction Act in the United States. So the precedent globally is there. What is it? What are the dots that are not being joined up here? What do the car companies tell you that they need to see?
Well, again, you know, what does Europe actually want? Right? One of the things is we need consistency in policy, right? And so, you know, putting these very stringent targets in for CO2 in the very short term and then moving them is also not helpful. These companies have been putting 80, 90, 100% of their investments into pure BEV. But they were hoping for a much more supportive environment that would actually generate the demand for EVs that we were all forecasting, which clearly is not happening. So that's on the one side. So we need to do much, much more for the consumer if we want them to go there. But secondly, on the industrial side, you know, just like the Americans, if you want European batteries, then you know, enable the Europeans to build European battery factories. And if that means that we end up putting tariffs on China, so be it. And that's what the Americans have done, right?
Is all the bad news in the price?
We think that, you know, for this year, generally speaking, the auto sector tends to be strong. November, December, January, you know, investors tend to buy laggards at the end of each year, you know, hoping for a better year next year. With the interest rate cuts and stuff like that, I think people will hope for a better year next year. And I think that could build a little bit of hope value back into the car sector for the last 3 or 4 months of the year, particularly given that we're really rebased in terms of, you know, short-term earnings expectations. So I think earnings could still be lower in 2025, but if we have 3 or 4 quiet months now after what has been a tumultuous 2 or 3 weeks, then I think there is some scope for recovery if that, you know, overall economic sentiment can improve a little bit.
I feel like what I'm hearing is policy matters at the end of the day, and I'm wondering how much of the story comes out of the U.S. elections and, of course, what happens out of the EU as well. Harald Hendrikse will lead the conversation there, Managing Director of Autos Research over at Citi. We thank you so much. Let's talk about another area that's largely going to be affected by the U.S. election, of course, the geopolitics in this region as well. We did get headlines from the new NATO chief, Mark Rutte, speaking about really the need to invest. It's, again, this theme we've explored not just through the show, but I want to say for years now in Europe as well, saying they'll be able to not only invest more, but try to close capability gaps, and will be able to work with both President Trump and Vice President Harris as well. Bloomberg's Max Ramsey took a deeper look at the challenges the new Secretary General faces.
He's one of Europe's longest-serving politicians, known for his positive nature and ordinary lifestyle. Mark Rutte used to cycle to work during his 14 years as Dutch Prime Minister. Now he's heading for one of the toughest diplomatic assignments that exists. With war in Ukraine, the redefinition of Europe's defense, and soon, a new US administration. Compared to his predecessor, Rutte is expected to be more hands-on.
And a lot of good things are happening.
He managed to keep former President Donald Trump on side in his last term, despite his fiery criticisms of NATO.
Let's stop whining and nagging and complaining about Trump, whether he might return or not.
His ability to compromise is seen as key.
Mark Rutte is a pragmatic coalition builder. He will need a lot of that because NATO is very much about coalition building.
He's been an important figure in securing support for Kyiv, influenced by the Malaysia Airlines MH17 plane crash in 2014 in Ukraine. It killed almost 200 Dutch citizens, and the government blamed Russia. Now he's led the way on sending F-16s to Ukraine, bolstering his reputation as a political force to lead the alliance through uncharted waters.
Bloomberg's Max Ramsey there talking about the change of power over at NATO. Mark Rutte taking over the reins from Jens Stoltenberg, again, as the head of NATO. Let's talk about what else we're going to watch out for today on the agenda. 10 a.m. UK time, we do get that Euro area CPI data as well. But I think the highlight for today is going to be at 2 p.m. Michel Barnier's policy speech is going to be coming up. There's a lot to debate there, especially when we're talking about the budget, migration, not to mention the politics with his own country. We've got Nike earnings after the bell as well. And not to mention what's going on over the States. The U.S. VP debate, 2 a.m. UK time if you're awake.
Absolutely. And we will certainly have coverage of that this time tomorrow, won't we? It strikes me, thinking of the election, you know, Mark Rutte now joining NATO, taking on that role, saying they'll be able to work with both Trump and Harris. We heard from Larry Fink earlier on in the programme, downplaying the relevance for investment allocation of the US election, talking about how, asked, do you deploy capital differently under Trump or Harris? And he just said, well, at the margin, but he thinks that maybe we exaggerate a little what difference that will make.
Those are two different conversations. The executive in the States has the authority when it comes to foreign policy in a way that is different, therefore, for Rutte to handle. When you're talking about investment, everybody I'm talking to at the moment is telling me they expect that actually we're going to see stasis. You may see one party taking the House, one party taking the Senate, maybe a different kind of one of those two taking the White House. There's going to be gridlock. From an investment point of view, that sounds...
That's what Larry Fink is maybe referencing.
Precisely, that's the Larry Fink kind of world that we're moving into. But from a foreign policy point of view, with tariffs and all that other stuff, and what happens in Ukraine and what happens in the Middle East, that's where the difference could be.
Well, this is also where is tariffs the right approach? And this is, I think, what's crucial about the Harris administration as well, if we do get one, is largely a continuation of what might be Biden's policies. That includes maybe the extension of tariffs on someone like China, but quotas or other kind of mechanisms on places like Europe. Remember, there are still steel quotas at the moment hanging over Europe, and that's one of the first things that Europeans have to figure out with their U.S. counterparts. There's a lot to digest, 37 days till the election, lot to play out between now and then. That does it for the opening trade. The Pulse is up next. I believe we're on the ground in Berlin, live at the Berlin Global Dialogue. Stick with us. This is Bloomberg.